International investors have managed to recover less than 1% of nearly $150 billion in bonds defaulted on by Chinese property developers since 2021, underscoring the immense difficulties in retrieving funds from the country's troubled real estate sector. According to an analysis by DebtWire, only $917 million in cash payments have been distributed to offshore bondholders across 62 developers in the past 3 years, amounting to just 0.6% of the $147 billion in defaults recorded. Out of nearly a dozen restructuring agreements, only 3 developers have made any cash coupon payments. The minimal cash recovery highlights the deteriorating financial position of China's property developers, which borrowed heavily in overseas markets before the sector's collapse, triggered by the 2021 default of Evergrande. Despite government efforts to stabilize the industry, something we've been following closely for years now, the flow of funds to offshore creditors remains nearly non-existent. A restructuring advisor in Hong Kong, speaking to the UK-based Financial Times, confirmed that no significant cash transfers have been made from mainland developers to overseas bondholders due to ongoing financial constraints. Offshore bonds represent only a fraction of the broader crisis, as total developer liabilities were estimated at an incredible $12 trillion by the National Bureau of Statistics in 2023. That figure is worth repeating. $12 trillion is owed by developers, an amount larger than the national debt of many countries. And this is the official number according to the central government. Some developers, including Evergrande, face winding up petitions in Hong Kong, but these legal actions have done little to impact their mainland businesses, adding to investor frustration. Even when payments have been made, much of the cash has gone toward consent fees and ad hoc creditor groups rather than general bondholders. Hopes for recovery briefly rose in 2023 when Chinese developer Sunac announced an offshore restructuring plan. However, the company recently stated that it would need to restart the process due to difficulties in meeting offshore payment obligations. The property downturn continues to deepen, with data from the National Bureau of Statistics showing a 10% decline in real estate investment in the first 2 months of 2025 compared to the previous year. Additionally, new home prices in China's 70 largest cities have fallen on a monthly basis, signaling prolonged weakness in the sector. For international bondholders, the outlook remains bleak. China is prioritizing the stabilization of its domestic real estate market over repaying foreign investors. Offshore creditors are left with little recourse, and unless a significant turnaround occurs in the sector, the prospect of meaningful cash recoveries appears increasingly unlikely. Has China already remade the international system? Michael Froman, president of the Council on Foreign Relations and former U.S. trade representative during the Obama administration, argues that, in a striking shift in economic strategy, the United States is increasingly reflecting China's approach to economic management, embracing protectionism, imposing tariffs, and intervening in markets. For decades, Washington promoted a global, rules-based trading system, urging China to abandon protectionism and open its markets. The expectation was that economic liberalization would eventually lead China to embrace free market principles. However, China instead expanded state intervention, subsidized industries, and prioritized domestic champions. Now the U.S. is following suit. Froman writes, Trump's new tariffs raised the average rate on Chinese imports to 19%, and his administration has doubled down on policies that restrict foreign investment and promote domestic manufacturing. Even President Joe Biden maintained many of these measures, reinforcing this nationalist economic approach. China's dominance in global manufacturing, particularly in electric vehicles, steel, and clean energy, has left Western economies struggling to compete. The U.S. response has been aggressive industrial policy, including the CHIPS Act and Inflation Reduction Act, which direct massive subsidies into key sectors. Meanwhile, Europe is debating whether to allow Chinese investments under joint venture models, similar to China's own requirements for foreign firms. The big question, Froman writes, is whether the U.S. can successfully compete using China's own playbook. The economic consequences of rising tariffs, retaliatory measures, and inflated production costs are yet to fully unfold. One thing is clear, he concludes. The era of unrestricted free trade is over, and economic nationalism is shaping the new global order. Taiwan Semiconductor Manufacturing Co., TSMC, the world's largest contract chipmaker, announced a significant expansion in the United States, pledging an additional $100 billion to build 5 advanced chip plants and research and development centers. The decision, revealed by TSMC chairman and CEO C.C. Wei alongside U.S. President Donald Trump, has sparked both economic and political concerns for Taiwan. For decades, Taiwan has relied on its semiconductor industry as a strategic silicon shield, ensuring its economic and geopolitical importance on the global stage. However, TSMC's increased commitment to U.S. production is raising questions about the future of Taiwan's dominance in chip manufacturing. TSMC's first U.S. cutting-edge chip plant in Arizona began operations late last year, and construction on a second plant is already underway, with pilot production expected next year. A third plant is slated to break ground this year, demonstrating the company's accelerated timeline for its American investments. Initially, TSMC faced major challenges with its Arizona facility, including labor shortages, high costs, and cultural differences, delaying completion to nearly 5 years. However, the company now expects to complete subsequent plants at a faster pace, more in line with its traditional Taiwan speed of 2 years per factory. Despite TSMC's reassurances, concerns persist. Experts warn that relocating advanced chip production could gradually diminish Taiwan's technological edge.